Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, stocks pointing to gains to close out a volatile week. Wall Street seeing the worst sell-off in months as AI concerns fueled a rotation out of tech. The State Street Technology ETF on track for its worst week since April. If you look at one ETF that tracks software, IGV is having its worst week since 2008. Plus, Amazon is sinking after announcing it plans to spend $200 billion on its AI build-out this year. CEO Andy Jassy says the money would go toward the company's Amazon Web Services cloud unit, calling it a, quote, extraordinarily unusual opportunity. And Bitcoin is off its lows after briefly falling below $61,000. Still, the cryptocurrency is hovering below that key $70,000 level. It is down nearly 50% since its peak in October. Let's get a check-in on stock futures here. We are seeing a bounce this morning. Will that bounce last? That remains to be seen, but futures across the board are up by about 0.5% for each of the major averages. But I want to get right to it. Let's dive into one of the biggest themes of the trading week, with nearly $1 trillion in market value wiped out by that software sell-off. But of course, it hasn't been limited to software. But take a look at some of the biggest names in the sector: ServiceNow, Salesforce, Microsoft, all of them coming under serious pressure this week as fears over AI disruption has weighed on investors. Joining me now is Dave Mazza, CEO of Roundhill Investments. They have a number of ETFs that include a lot of these names and other buzzy names. Dave, it's great to have you here to kind of like digest this crazy week that we have seen. There have been some precipitating factors, right? We had Anthropic rolling out some new products. We had OpenAI rolling out some new products, which rekindled perhaps these concerns that AI is going to eat software. But it wasn't just software falling, right? It was broader in tech. As we all sort of try and wrap our heads around what happened this week, what are you thinking about? What's top of mind for you?
Yeah, it's interesting. If you look at the broader markets, I mean, we're really not that far from all-time highs, but it feels much worse because, to your point, there's been a lot of damage under the surface, particularly in what we'll call kind of high beta momentum names. We've seen a significant reversal in their performance. So the best performing stocks over the last week, or the best performing stocks over the last year, have been the worst performing in the last week. And those that were out of favor have now come back very aggressively. And there's a few factors at play here. Some of it is that if we look at the sort of cohort of both hedge funds and then retail investors, many people have loved these names. And when we see sort of the impact that Claude announcements have had on software, that starts bleeding through to the broader market, causing a lot of turbulence under the surface. So I think we're at a period where there's going to still be some digestion of exactly where positioning falls out, because there's a lot of technical factors at play when you have leveraged ETFs, zero-dated options, all in the same trades. The second that becomes to crack, the pain can kind of exuberate very, very quickly.
Yeah, and that's definitely what we've seen happen. I do want to point out as well, even that IGV ETF, which is one that we're watching really closely, which is sort of software plus, right? That is down about 12% this week, the worst since 2008. But the sell-off didn't start this week, as you well know. That IGV actually hit a record back in late September, and since then has fallen by more than 30%. And I wonder, I think about sort of Liberation Day. There was a big decline in software stocks and everything at that point. But the sort of key there was the unknown, right? What is tariff policy going to look like going forward? And it seems like the unknown here, nobody really knows which businesses are going to be disrupted on what timeline and by how much. So if you don't know that, can you come in, can you step in and buy any of these names with any confidence?
Yeah, look, on one hand, market corrections are actually quite normal. They're healthy. We need them actually for the market to be on strong footing to continue moving forward and grinding higher. What's a little bit scarier this time around is exactly to your point. Around last year, if we recall, in February, we had the DeepSeek news. Tech AI stocks fell really sharply, thinking there was no longer going to be demand for NVIDIA chips. Then we have Liberation Day sell-off, then a huge reversal. This time around, it's unclear exactly what the catalyst would be for the market to recover very quickly. So I think investors are starting to question, is this actually more of a DeepSeek Liberation Day moment, Or is this more like 2022, of course, when we had Meta's concerns really bringing down the broader tech sector? What's interesting this time around, though, even if we look at Amazon's results, of course, they were mixed, not really a clean beat, but AWS came in better than expected. These companies are generating, particularly the Magnificent Seven and mega cap tech, unbelievable amounts of revenue, growing and accelerating that revenue at strong paces, which just simply by the law of big numbers is sometimes hard to fathom. But the real concern is, what does the future look like? We know that Amazon guided to 200 billion of GDP. That's roughly the GDP of Greece. If we look at all the hyperscalers, they're now projected to do over 600 billion in GDP. That's the GDP of Sweden or the GDP of Massachusetts. So the numbers are massive. And I think investors are now kind of really being more discerning of saying, well, hold on, I thought we were going to start seeing return on investment in 2026. Now you're telling me there's more spending. So people are really pulling back before they begin to say, how much do I want to value a company, even if it's growing, knowing that they're moving from a capital light industry to maybe more capital intensive industry.
And Dave, I wanted to play for you some of the commentary that we've been getting throughout the week, kind of looking at what investors should do now, how they should be reacting, and then you and I can chat about it. So here's what a few folks had to say.
We actually think that software companies are overly maligned right now. They do provide very valuable services to their customers. They're still very good businesses, growing fast with good margins that can scale well and are hard to switch out of.
What we've been telling people even coming into the year is like, look, let's start to diversify away from some of this AI trade. And what we watch is leading indicators of the economy. We watch inflation expectations. We watch where the Fed is ultimately likely to go. And all of that suggested to us a broadening of a market and a weaker dollar.
As we think about investors rotating into what I would call old economy sectors and stocks, whether that is transports, regional banks, chemicals, oil and gas. And I think there is a good reason for that. And this week's rise in PMI, looking at manufacturing activity, expanded at the fastest pace in over 3 years. So there is hope that we're seeing a turn in the industrial cycle after a long period of stagnation.
So obviously, Dave, a lot of different opinions in there about what to do now. I mean, the other thing that traditionally people would have done now was to go into safe havens or what they perceive as safe havens. But if you look at the traditional havens, obviously gold and silver have been incredibly volatile. Bitcoin, which was seen by some as a store of value, has not been a very good store of value. So what do people do now?
Yeah, I mean, even in those clips, you can see the dichotomy of opinions and sort of some of the confusion, I think, that's settled into markets, at least for the time being. And where I think investors are rightfully so looking for other opportunities, right? Most people have identified the AI trade. From my perspective, whether we're talking about retail investors or institutional investors, not a lot of folks have been looking at staples and energy, which are the two best performing sectors year to date. Interesting pairing, though, because, of course, staples more of a traditional defensive sector. Energy less so, much more cyclical, because at the same time, if you look at the economic data, as one of those other guests said in the clip, it actually has been improving, even though it certainly does not feel that way. Then you have the challenger job cuts data really questioning people about sort of the health of the economy. So I think investors really, especially with sort of some of those technical factors that I mentioned early, pull back pretty hard. I think net, of course, because of metals, particularly gold and silver, have become a bit of the momentum trade, are not providing that store of value really in the last couple of weeks. But over time, I do think investors do want to have a more diversified, broader portfolio. Those are areas which are traditionally uncorrelated to stocks and can be very valuable for investors' portfolio. And at the same time, I think a lot of folks don't continue not to recognize this. Non-US investments have done particularly well over the last year. And maybe if we look going forward, there could be further opportunities there too. So there's still areas of the market that remain undervalued, that provide sort of the potential on a go-forward basis. But because everyone has been so focused on sort of AI disruption and some of the adjacent themes that can come from that, I think investors have maybe over-allocated to those areas. And what we're seeing on one hand is a bit of a rational pullback from that, a reassessment particularly to your earlier point, that it's really difficult to ascertain exactly what impact is Claude and other AI sort of models going to come out to really disrupt business models going forward.
Dave, great to see you. Thanks a lot for being here.
Thank you.
And as we were talking about, of course, one vital cog in big tech is Amazon. Those shares are falling sharply, showing it as yet another indicator of investor fears over AI disruption. The revenue outlook from Amazon fell below Wall Street expectations, and Amazon's planning to spend $200 billion in CapEx this year. Rohit Kulkarni is with me. He's a senior research analyst at Roth Capital Partners. I mean, I'm getting tired of saying the CapEx number was higher than we expected, Rohit. Like you guys all on the street, I guess do you just have to raise all your CapEx forecasts at least a quarter or even a half, right, going forward? Is that what needs to happen?
Yeah, I think this entire cycle of surprises of, okay, CapEx is higher than expected has been going on for far too long. As in, I think the companies also are putting the next kind of threshold slightly ahead of what the street was expecting. So that environment of negative surprises, and for a company like Amazon that has just far too many surfaces of risk, be it commerce, cloud, ads, and so many other parts of the business, that creates a series of yellow flags, if you will. I think, but you're spot on, Julie. I think we all sell-side analysts should just decide that, put the CapEx number so high, so next time all we need to do is lower those numbers. But that's, in all seriousness, I think what Amazon is doing is investing from a position of strength, and we like it. We think you just need to be patient to appreciate this Gen AI winner, in my opinion.
And in the case of Amazon, ROI is like the mantra right now, return on investment. So in the case of Amazon, walk me through what that looks like.
Return on investment should ideally show up in all three parts of the business. Right now, the return on investment is showing up in the cloud, AWS side, where last 3 quarters, growth rate has gone from mid-teens to almost mid-20%. And we see the next couple of quarters that mid-20% growth rate to probably go even higher, given what CapEx has done. So that checks the box very well. That's in line with what Google has demonstrated recently. So we like that. But remember, Amazon is one of the world's largest retailers, one of the world's largest ad companies and media companies. So I think for that to demonstrate some accelerating growth or some direct linear ROI probably takes more time and more money. And that's where this $200 billion CapEx number comes in, that it's a much bigger business, much more diversified business, and hence more money and more time is required. So to get to your question directly, Julie, I think we need e-commerce growth to go solid double digits. It's been between 8 and 11% over the last year and a half. If AI is actually demonstrating ROI for Amazon, I think we need e-commerce and ads both to grow solid double digits.
Well, what does AI do for the e-commerce side really at this point, Rohit? And how much can it do if consumers, particularly lower end consumers, are challenged?
I think the way we see AI help large companies like Amazon in the e-commerce side is, again, you may or may not have used their AI chatbot called as Rufus. There is that that can help people find the product that they're looking for a lot quicker than what otherwise you would have had to search through, sort through, filter through a whole bunch of search results. So that conversion from a discovery to actually finding to checking out a product, that entire funnel that Amazon has over the last 10 years very fine-tuned to a normal checkout flow, AI can make it a lot faster. So again, I believe we are in a very early inning with that manifesting in Amazon's numbers, but the way it would manifest is more units sold. So for example, in Q4, the number of units sold were accelerated a slight bit. Again, they sell millions of units every day, and so that acceleration is commendable, but we need more. So I think those results, those kinds of tidbits in the next couple of quarters will give people confidence that, hey, you're spending on AI and it's showing in places that actually matter, like commerce and ads.
Rohit, gotta leave it there. Thank you so much for joining us. Really appreciate it.
Thank you.
Coming up on Morning Brief, we'll bring you today's top trending tickers and talk about recent action in the U.S. dollar. We'll be right back. Now time for some of today's trending tickers. We are watching Strategy, Stellantis, and Reddit. And markets and data editor Jared Bluegree is joining me now. Let's talk about Strategy. Stock is rebounding this morning alongside Bitcoin, and the company's reporting results last night, posting a $12.4 billion loss driven by declines in Bitcoin at the end of the year. Executive Chairman Michael Saylor appeared unshaken in the wake of this drawdown on the conference call. He highlighted President Trump's support of crypto as the foundation for gains ahead. That has not worked out so far, obviously.
No, I mean, one of the questions I've been asking people on the podcast and in these studios is, in 2025, we had one of the most crypto-friendly regulatory environments ever, and we made new highs in the beginning of the year, but then it petered out, and I'm just wondering what the next catalyst is. We were talking yesterday, Julie, and I think has to be another business use. But let's get back to the main point, because I've got some comments here from the Strategy earnings where they posted a loss of $42.93 in EPS, but here's benchmark with a price target of $705. That is high. Strategy posted yesterday after the market close, landed on a day when markets were in no mood to entertain nuance. Bitcoin was sliding hard, risk assets were buckling, and the company's share price fell 17%, dropping to its lowest level in roughly 18 months. And here's another one, Cantor Fitzgerald. While the Q4 print gave us another look at the company's financials, investors are understandably more focused on Bitcoin price dynamics and Strategy's ability to manage a crypto winter. There's that term, crypto winter, which, I mean, it's hard to deny that we're in that. Crypto winter means you got to find a bottom sometime, but that usually takes some time.
If you're leveraged on the way up,
yes,
leveraged on the way down.
Well, that brings me to a chart here. Let's go to the Wi-Fi Interactive. We can see right now Strategy is up $7 or 7.5%, up to 115. But I want to show you Strategy versus Bitcoin, and this is something I've been showing for a while. This is a one-year look, and purple is the iShares Bitcoin ETF as a proxy. Strategy is in cyan. You can see Strategy is down 68%, and where they diverged was really in the middle of last year, August, September, and you can see Strategy. They say it's a Bitcoin proxy, but it's also kind of like a high beta play. It went lower than Bitcoin in the April sell-off and went higher on the rebound, but they have very much diverged. Now this year, it was looking a little encouraging because Strategy was once again outperforming Bitcoin until about 5 days ago. And I'm just going to go to a Strategy chart here. I'll put, there's 5 days, down 25%, and that hurts. So there you go.
It does. We'll see if it'll continue to hurt, even as the stock is bouncing in pre-market this morning. We'll see how long that lasts. Let's talk Stellantis, too. Those shares are plunging after the automaker announced a $26 billion write-down as it scales back its EV push. And before we kind of get into the fundamentals of this, I just wanted to pause for a moment and just talk about, we've talked about this before, the moment that we are in, that a company like Stellantis is down 25% after earnings.
They're big.
But this is now the norm, right? That we see these enormous swings after very large companies that used to be very staid. Maybe you would get a single-digit drawdown after the earnings, because the options activity and the retail activity has really supercharged these kinds of reactions in the market.
Yes, I think investors are conditioned to a much faster-paced market, and you can criticize the company, well, they should have guided or whatever, but to your point, a lot of stocks are, in fact, the entire market is kind of acting like this. Yeah. And I would point out, to the detriment of investors, the last few sell-offs that we've had, especially in April of last year, it was so quick to get back to record highs here in the major indices that I think investors are a little bit inured about the downside here. Oh, we'll just get back to break even in a few days or weeks, but that's not typically how the market works. So you got to remember 2022 and not necessarily the pandemic, because that was another fast rebound. Yeah. And I don't think it's going to be long as the tech crash bubble. That took years and years to play out. But we definitely have a much faster market. To your point about, let's get back to some of the earnings here, though. Yeah. UBS, which has a buy rating on it, said this should be the clearing event we've been waiting for. However, Auto, which I don't have a price target, but they do rate the stock neutral, they have a different outlook. It's hard to call today's announcement a clearing event, yet given the uncertainty still surrounding the execution in the coming quarters. So clearing just means that you have a reset and investors can finally say, okay, we're starting over here, but that's a little bit muddied now. We got different opinions on that.
Yes, interesting. That's what makes a market. All right, let's talk Reddit. That stock is jumping on the back of earnings, which beat analyst expectations on the top and bottom lines. The platform's first quarter guidance also coming in strong. It announced $1 billion share buyback also, and those shares up 6.5%.
Yes, so I'll give you a couple of analyst reports on this as well. Here's Bloomberg Intelligence, which doesn't really, they're not quite an analyst because they don't rate stocks, but Reddit's first quarter outlook indicates top line growth is likely to remain above 50%, supported by steady engagement and continued advertising momentum on its platform. But there are concerns about the U.S. growth in terms of users that are logged in, and that's one particular metric. So here's Truist Securities. The results and outlook show solid momentum across monetization and user growth. And then RBC, Reddit's fourth quarter featured a big beat on top and bottom lines and solid guide for Q1, offset by further deceleration. That's what I was looking for in U.S. logged in DAUs. That's daily active users. That grew 5% versus 7.4% last quarter. And that reinforces the LLM bear case. So what does that mean? Well, so the growth is down a little bit. It's still growing, but AI is kind of taken over everything, and there are concerns that it's eating into users staying online longer. And so that's the concern with Reddit. But as you said, it's up in the pre-market here, 6.5%.
Thanks, Jared. Appreciate it. All right, let's talk about the dollar. It's fallen about 9% in the last year as investors' risk hedging strategies shift away from the U.S. Yahoo Finance's Jake Conley joins me now with more on what the market is showing. Two buzzwords that we've been hearing more about: de-dollarization and the debasement trade are like the two things that people are talking about. So how is this all happening in the market?
Right. You go back to last April, Trump's Liberation Day announcement with all those tariffs that came into play. The dollar dropped several percent right after that, has remained depressed and kind of flatlining over the past year, still down 9% from the past year. So it's a sizable drop. While that's been happening, you've seen a lot of other currencies picking up in its place. Not only the strong ones like Swiss franc or the euro, but also some of these more risk-on emerging markets currencies. South African rand, Brazilian real, Mexican peso are all doing really well against the dollar. Is it debasement? It's probably too early to call it that. Analysts at Bank of America have been saying that if it was going to be a full debasement trade, you'd see everything in the US doing poorly. The dollar would be down, also the stock market would be down. You'd see risk in the credit markets. With the exception of the last couple of days with the software sell-off, stock markets are actually doing pretty well right now. The credit market in the US is not showing too much stress, so it's probably too early to call it debasement, but it's certainly early enough to say that investors are starting to think about risk differently.
And what the difference is, just for people who are watching, at least in my mind, is if the dollar is the world's reserve currency, that's the word that people use a lot when they're describing the US dollar, it would be a more fundamental shift away from that would indicate debasement, right? If global central banks, which yes, have been adding to their gold positions, but if they had been getting rid of dollar assets in a more dramatic fashion, to your point, across the board, that would be a signal more of a broad-based debasement trade.
Exactly. You'd see some of those really broad movements out of the central banks globally. But I think the difference here, Julie, is where the risk is coming from. Years past, risk emanated from outside of the US, and the US was able to act as a stabilizer. It was kind of this global safety haven. The dollar was seen as a safe haven asset. In the last year or two, you've seen that picture change for investors. More and more geopolitical risk is coming from inside the US. You see the tariff threats, Trump's moves on Greenland, on Venezuela. All of that is now saying to investors, what used to be a safe haven is now where a lot of this risk is coming from.
Right.
And now that you have Kevin Warsh being nominated for the Fed chair, if the Fed were to start cutting rates, as Trump has asked for, it's not clear if they're going to, that's a group decision, but if they were to, that's going to bring down the yield and bring down some of that premium that investors would usually get from a dollar and usually expect from it.
Right. The call is coming from inside the house.
Exactly.
As I say. Thanks, Jake. Appreciate it.
Thanks, Julie.
Coming up on Yahoo Finance is Opening Bid. Executive Editor Brian Sazzi is joining us to let us know what to expect from Opening Bid today. Tell me.
Hello, Julie. Well, first up, we got Roblox CEO Dave Baszucki coming out right at the top of the show. The Kevin Hart's going to come on later, talk about his on fire tequila brand. But Julie, I just want to get my show done because I want to see you salsa dance on Bad Bunny. I've been hearing like little murmurs throughout the newsroom.
I don't know if we'll be playing Bad Bunny because of fair use rules, but that's a whole nother.
But I want to
topic.
see you dance, Julie. I need to see it.
You can see me dance anytime in the newsroom. What I want to know is Kevin Hart buying software stocks?
If you dance, I'll ask Kevin. If you start dancing, I'll ask Kevin that question.
Like right now?
Yep.
Okay, no, thank you. All right, we'll see you later. Bye, Brian. You'll have much more of whatever that was next on Opening Bid.